Hello, everyone. Welcome to Budgeting and Forecasting for Broadband Providers. Today we'll have three speakers, and they are Mark Albertin he's the CFO of Whisper Internet. He's been the CFO for a little over 2.5 years, and prior to Whisper, he was a CFO in education and training in South Africa. He's been in finance for over 25 years, and he has undergraduate and postgraduate degrees in finance from the University of Pretoria. He's also a qualified chartered accountant, which is similar to a CPA in the US. Then next up, we'll have Rob Bresnahan is the CFO of Fibersmith since 2019. He has 18 years in public accounting, primarily focused on rural telecommunications. His experience includes financial reporting, performing audits, reviews and compilations, business income tax preparation and planning, partnership and tax-exempt entities, personnel training, regulatory and property tax reporting, budgeting, investment accounting, and projections. And he has a BS degree in accounting from the University of Wisconsin-La Crosse and is a CPA in Colorado and Wisconsin. And then last but not least, Piers Verchik. He's the VP of Broadband Lending Team at Live Oak Bank, and he has experience with conventional SBA, USDA, and letter of credit products necessary for broadband providers to leverage when thinking about acquiring a competitor, purchasing commercial real estate, expanding your network, or participating in grant programs. Piers has a Bachelor of Science in Finance and Government from Wofford College in Spartanburg, South Carolina. Hopefully I didn't totally butcher that. Okay, so first up, Mark. Mark, just let me know when you need to switch slides.
All right, thank you. Thanks very much, and good day, everyone who's watching this. I think it's kind of quite exciting that we can use this platform to deliver this. I know we're not at Whisper America, but I hope first of all, just starting off, that all of you are safe out there, and just looking out for yourselves, your family, your friends, colleagues during this time. So I think just starting off, and Martha, you can go to the first slide. I think just to set up, why do we budget? Why do we forecast? So I like the quote from Benjamin Franklin that, if we fail to plan, then we're planning to fail. And I think this is relevant also not only in our business lives, but also kind of in our personal environment and the place we find ourselves as well. Is we need a plan, we need a strategy. And so I know there's a lot of, and Martha, you can flip to the next slide. I know there's a lot of kind of businesses out there, and some people that, they see this scenario. It says today's financial report will be a short one. We had money and now we don't. So just as simple as that. So what we're trying to do by obviously doing some budgeting and forecasting and budgeting is we're trying to make sure that our businesses, we don't land into that situation where we had money and now we don't. And I think especially in the fixed wireless business, where it's very capital intensive up front, that can be certainly can be a reality that a lot of the businesses out there face. So Martha, you can go to the next slide, please. So just kind of, just to start off with definitions, and, I think we'll all talk to this a little bit, the difference between forecasting and budgeting. And really kind of forecasting is an estimate of the future outcome that we'd like to see. And that's usually more a high level, a summarized format. So, as an example, in our environment, we've got a CAF build out to build out to, and we want to forecast to estimate we'll reach whatever 5,000 customers, 10% of our locations this year. And then really moving from there is then how do we achieve that, those goals and objectives? How do we get to our forecast? And that takes us then to our budget, which is more a detailed statement of our expected revenues and expenditures. It's really the tactical plan that helps us to achieve our desired outcome. So like I said earlier, with if we fail to plan, we plan to fail. We need our budget that helps us to give us the plan to give our best efforts at being able to achieve our forecast. So kind of how I like to look at the budgeting, and Martha, you can skip to the next slide, please. How I like to look at the budgeting process is there's kind of three elements to it. You can click for me, please, Martha. The first one really is the analysis, the planning, and the strategy. And in the next few slides, I'll kind of talk to a couple of those. The second step in the process is really going about preparing the actual budget, finalizing it. And then the third step, Martha, you can press, is the actual, when we're living out our budget, living, breathing the budget, the reporting, monitoring, and how we adjust the budget based on actuals where we find ourselves. So kind of in my next slide, talking to the first one there, thanks Martha, is the analyze, planning and strategy part of the budget. And sorry, I'm just getting my notes here. So first of all, we always like to start with analyzing the macro environment. What's happening on the bigger scale. Obviously, we're dealing with a COVID, so it's just obviously it's affecting all of us. It affects the macro environment. How does it affect our supply chain? Being able to get our equipment. What does that do? We need to put some planning in for the events and what's happening in the macro environment, because then that obviously has an effect on the micro environment where we find ourselves. What is our lead times? What is our order times that we need to factor into account? If we can't get stock or inventory, then what do we do? So building in an element into any of our plans to take that into account, I think is always a smart thing to do. Just some of the other things which has had a factor in terms of the environment where we find ourselves in is, what are the FCC, what are the regulations, federal, county laws? In terms of CAF, we are required to be an eligible telecommunications carrier. And what factors does that bring into account into your budgeting and planning? Risk analysis in any environment, any business, there's always the risk. So really looking at your risks there. And when we look at risks as well is, we also look in terms of our time frames. Usually budgets are a 1-year time frame, but some people budget a medium term. In South Africa, we had what we called a medium-term expenditure framework. So we had a detailed 1-year budget, and then we had 3 years looking forward. How's that going to roll out 3 years going forward down the line? And then I think with any budget, there's kind of, for me, there's different objectives that one tries to achieve in a budget. Are you looking at trying to get a balanced budget where income meets expenditure? Are you looking at generating a surplus budget? And in a lot of our environments, we for-profit motive companies, you're looking to make a surplus in terms of your budget, get a return on equity for your investors. However, there may be cases where there will be a deficit in your budget, which you will then need to fund, which that could be another risk as well. For instance, now where we find ourselves in a high build-out growth phase, there may be a deficit in the budget, but then knowing that you have to fund that deficit in terms of cash flows. So you can skip to the next slide, please, Martha. So having a look here then at kind of our approach that we follow is there's different ways of doing a budget and getting to a budget. And with any budgets, once you've entered into your first budget cycle and you've gone through that, it's always easier to in the next years to tweak it. But there is merit to do incremental based budgets. So we know what we've achieved in this past year. And then incremental based would be knowing that we're going to build out X amount of towers more or add in X amount of customers. We grow that by 3, 5, 10%, whatever that may be. I know in South Africa we had a high inflation environment, so we certainly built in incremental based budgeting into all of our budgets. We had inflation there ran 6%, so we needed to include that in all of our budgeting. So because all the costs go up, and so very important. In terms of Pierce, did you want to hop in there? I saw you wanted to say something. Are you good? Okay.
Oh, I'm good. Thank you, though.
All right, good. In terms of the other approach is zero-based budgeting. I followed this in a previous organization I was involved in. Is really at the beginning of each year, we kind of start at zero. And we say that for every dollar that you want to spend, then you need to make the business case for it. So in other words, in any budget, there may be some inefficiencies built in there. There may be some, as we'd say, fat built into there. So the benefits of a zero-based approach would really be to reset and say, we start at zero. So you don't just get X plus in terms of your budget, but make sure that each person comes in and actually justifies the need for the budget and the spend. Another thing that I know that we look at in terms of any budgeting is what is a centralized budgeting approach and what is decentralized. What I'm meaning by that is in terms of some of the centralized functions is from the HR perspective, we provide uniforms for all of our staff. So that centralized budgeting can be a headcount. In terms of from the finance side, the budgeting for your bank costs, those sort of things. So we can do that as from a centralized perspective. The other, obviously, decentralized perspective, if you do that, you wanting to give those that are actually at the coalface, you want to give them opportunity then to budget their needs. And so in any budget that I've been part of, there's always a mix of centralized versus decentralized. Who does what? So we've got area managers. So in terms of the decentralized process, really, they would feedback up from their side of things what they need for their budgets, which leads me kind of to the next 2 points. There's really your, more first of all, the top-down versus bottom-up. Some people follow top-down, where the management decides what's the budgets and rolls that down to the rest of the staff. And I find there's, one of the limiting factors there is it's very difficult to get, buy-in sometimes of all the rest of the staff. Versus bottom-up approach is where we have actually been going through a process now is where we've said to all the general managers to, what do they want to achieve? What are they going to need to be able to achieve that? Really trying to empower them and equip them with what they need to be able to achieve their outcomes. And with anything, there's always delegations of authority. How we like to budget and manage is try to empower our managers to be able to make decisions by themselves without everything having to flow up and the CFO, for instance, having to make the decision on everything. It's really empowering and equipping people to make decisions by themselves. However, there are threshold levels, delegations of authority, where if you go above X spend, then that comes up for approval up the line. Martha, you can move to the next one, please. So moving then on to kind of the start of the budget is, the assumption that one makes. With any budget, there's obviously usually a whole bunch of assumptions that go into being able to draw up your budget. For me, there's always what are the fundamental issues that'll affect the budget. For us right now is we've got certain CAF2 requirements that we need to build out to. So that plays a big factor and role in terms of all of our budgets. That actually kind of defines our direction and where we need to be. What are your biggest revenue and cost drivers? And in our business especially is what are your CapEx requirements? Those are fairly simple and easy. Well, when I say simple and easy, relatively, if you know how many towers, what equipment you're going to build and put on your towers, that you are able to cost that out and determine what are your CapEx needs. Then we know for as you grow, you can make assumptions into what's your penetration going to be in each of the markets. So you have a 10%, 20%. If you know the amount of homes in that area that you can reach, you can make some assumptions around how many homes you're going to be able to sign up, and you can cost out your CapEx requirements based on that. Another assumption, which I did allude to earlier, depending on how your budget and cash flow, we know a fixed wireless operator requires a lot of capital, upfront capital. So, do you have access to capital? And if so, what's the cost of that capital? Because that has an effect on your cash flow, and very important, cash flow. Cash is king, they say. And the other one of the biggest costs for us is the staffing costs. So that always is, besides some of your CapEx, that's always the biggest cost in our business at the moment. All right, you can move on. So in terms of once you've done all your planning, just really moving on to the prepare, review, and finalize. Income projections. So do they meet your goals and objectives? I think there it's important to know what's the timing, what's your assumptions in terms of your penetration rates to make. So we built out a new tower. Do we get to 10% of the customers? And so, if so, how quickly are they going to sign up? We maybe will get 10% penetration, or 50% if we're the only provider in town, or 100%. But then over what period of time? Because that's important to map out when you're going to add those customers on and sign them up, because that increases obviously your cash flow as and when you sign them up. Then looking at expenditure and cost, do they exceed income projections? In all the budgets I've put on, our costs always exceed our revenues. So there's always a trimming back of what do we trim back and what don't we. As I mentioned before, just in terms of a cash flow perspective, in any budget, if we once we've mapped out what's our income, what's our expenditures, we then review our cash flow because as you know, there's always a timing difference between the cash invested, the expenditure side of things, and when we're going to get a return on that capital invested. Lastly, in terms of looking at our ratios, looking at the balance sheet ratios, especially when and I'm sure Pierre will probably touch on this a little bit more later, when if you're loaning money, then the bank's always got some covenants that you need to make sure that you keep and adhere to. So it's really important to make sure that as you mapped it out, planned out your budget, that you're adhering to your financial ratios and covenants that you have with your funders. Thanks, Martha. Then lastly, I just want to touch on, once you've got your budget in place, you're operating, what does one do with that? So in our scenario, we have produced monthly management reports. And we try, when I say timing of recording is important, in any accounting, there's the matching, income expenditure in the same period. So the timing, make sure that you are recording your expenses in the periods that you incur that, because then you can compare that to your budget. For us, we investigate any material variances, and we define material as anything that's over 5% of difference between that and the budget. We know also in terms of our reporting on a monthly basis, monthly, quarterly, and then obviously at the end of the year, in terms of our KPIs, key performance indicators, are we meeting them or not? And lastly, just reviewing our profit and loss, balance sheet and cash flow ratios and covenants. And I think for me as well is that we don't always want to just get stuck that this is the budget and it's fixed and it doesn't change. I think for a large part on the shorter term, that is so, because we did planning to meet that. But in the longer term, all things do change. And if radical things change, for instance, this COVID virus, we need to be able to adjust and reset our budget and account for the unexpected. So I know I've been talking kind of very much kind of high level and some of the strategy and planning. I hope it's been able to help some of you. And I'd welcome any questions on anything, whether it's on this call or anytime later. You're welcome to email me, and I'll be happy to help anyone. Thanks very much.
Great, thanks, Mark. So next up is Rob, and I actually think that phone call might have been on my computer, so I'm going to try to fix that, Rob, before we go. Hold on.
Okay.
Nope, it's not on my computer. Huh. All right.
I'll just jump in then. I'm
okay. Great.
Rob Brokenham. A lot of you probably have seen me. I've been the kind of one of the financial speakers over the years here at WISPA, and it's great to have this. You can see I'm in my garage. It's the best place for me to be and not have my kids drive me crazy when I'm trying to do this. So, if you don't know who I am, I've been doing this telecom, accounting, auditing. I did that for about 18 years. That's all I did. I've seen every aspect of this business. CLEC, ILEC, WISP. You name it. I've looked at it and I've done it. Done a lot of forecasting and a lot of budgeting in the past. A lot of different people. And one of the big things is you have to remember that this is all about what stage you're at and what you need to do, because the budgeting and the forecasting is all, there's a lot of different methods to it. There's a lot of different things. And like Mark said, you can see from Mark that he was at a very high level. And we saw, we thought getting Mark in here and explaining how he was going to be doing it was going to be great. Seeing that top level, that big company, aspect, or the larger company, seeing where he's coming from and looking at it. But a lot of the people that, are watching this presentation or have come to this presentation in the past, they've been people that don't really know how to budget or forecast, or have never done it, or have tried it a few times. There's a lot of different ways to do it. So Martha, if we can go to the next slide. There we go. I will say this: I'm the CFO of Fibersmith. I'll let you guys know that. I run the financial division of Fibersmith Financial. So I offer virtual CFO and financial consulting services, which means I've gone through my actual first real budgeting season, preparing budgets for companies, and not just putting together one big forecast for some objective. So I've seen both sides of it now, doing it from the big CPA firm aspect, and then also doing it from internally. So a couple things I will say this right off the bat. I agree with Mark. Don't live and die by the budget. Everything that's going on now in society, with COVID and everything, that is one good reason to adjust your budget. But at the same time, remember that there's other things that you can adjust for, that you need to adjust for. You can't always come back and relive, some big shortfall you had in the first quarter. Make an adjustment to your budget and your forecast for that. Always adjust for what's coming up, because one of the old adages that I was told in my younger years was the minute that you get a budget set in place, it's already outdated and it's already changed. So, that's one big thing to remember. And the other thing is, the first time that you budget, forecast, or anything, it's always the hardest time. Okay. Getting into the process is always the hardest thing to look at. Hardest thing to manage, hardest thing to get everybody on board for. But once you do, people really start to like it. So let's just start with this. Budgeting, forecasting, projections, Proforma, everybody uses a different word for it. I hear Proforma more than anything nowadays. And each of these four is completely different. Like Mark alluded to, Mark was talking about budgeting and forecasting. From the CPA firm world, where we had to do official reports on all of these things, every one of these is different. And I think the differences are key to knowing where you want to be, what you want to do going forward. But the biggest thing that they have in common is they all focus around the three basic financial statements: your balance sheet, your income statement, and your cash flow. So we always take those, and the key to doing any of this is you have financials and you build off of that going forward, 1 year, multiple years, just 6 months, whatever it is. Let's go to the next slide. So we look at a budget. This is what Mark was saying. Budget usually is about, you look at about a year. We just got through with budgeting time in the fourth quarter, because you want to get that approved for this next year. And we're, just about in that end of first quarter, I have to go back and report all the budget information. But, a budget is a statement of intent. I really like how these descriptions came through. It's based on management's current intentions and objectives. So what you're doing right now, when you set up a budget for the next year, it's what does the company want to do? What do you want to do? What do you want to, aim for? You just want to shoot for, status quo this year, or shoot for 5% increase or 10% increase? Budget is just how you go, day to day and make your operations work. At the bottom of each of these slides, I got these nice little quotes, but where you want the business to go. What do you want to do in the next year? That's the easiest way. Aspirational goals for the businesses. I think that's a good explanation of it. Let me get my notes. And this can be anywhere from a full financial statement budget to just a CapEx or a cash budget. I think that's one thing to remember truthfully with people. But everybody should be doing some sort of budgeting. Budgeting is the most basic type of predictive analysis. The more people that we talk to, and Mark, you can chime in on this if you want, but everybody we talk to at WISPA, this is not really on people's, on their tongue. That's not what they talk about. It's not what comes up in conversation, but more people need to be doing this. So.
Yeah, I agree 100% with you, Rob, for sure.
Yeah. So we need to start talking more about budgeting and forecasting and predicting and seeing what can happen, and not just on a company level, but you can also do it on a project level. Most everybody does it on a project level. You'll see, well, if I put a new tower up, what are the impacts of it? That's budgeting. That's forecasting. You're checking to see, is it feasible that you can make money on that, or that you'll get enough customers? So everybody that's watching this and everybody that's listening to this, you're already doing some type of predictive analysis. Okay. It's just a matter of formalizing it and letting it adapt to your company and what your needs are. Okay. Let's go to the next slide. So now the first, real pushing out, because budgeting is about a year, forecasting is really getting into, past 1 year or what's going to happen. So, really good description of that is it's the financial outcome based on assumptions, which is what you want to do, what the course of action is. So this is pushing it out more than 1 year. Usually, 3 to 5 years is what, I tell people. In the auditing world and the, CPA firm world, the standard was 5 years, but you can do 1 or 2 years. You can do whatever you want, but usually try and go out more than one for these forecasts, because you're looking at what you want to do. Where's the business going? What do you want to grow in the next few years? Do you want to cut your expenses in the next few years? What do you want to do? And this isn't just saying, well, I'm going to grow revenues for the next year, and you put a revenue goal out there and try and meet that. Well, that's great, but at the same time, you need to take all of the factors into account. That's what, this, course of predictive analysis does. So let's go to the next slide. So projecting, this is kind of the what if situation. Okay. So forecasting is kind of day-to-day operations. Budgeting is 1 year. Forecasting is kind of taking a budget and pushing it out to more than 1 year. Projections, this is hypothetical assumptions. This is what if. What if I bought somebody, or what if I bought these towers from this company, or what if I acquired, a bunch of assets or a bunch of land or whatever it is. So you're looking at a hypothetical assumption that is consistent, with the purpose of this, but not necessarily expected to happen. What I would do mostly, and I still do a lot of them today, is I do projections to see what someone can do, or how they will, how the company will benefit from borrowing money. So if somebody was going to get a $3 million loan to put fiber in, we would put a projection together, and we would say, here's all of the assumptions that we're putting together. If we borrow this money, we're going to do this with it, and then we're going to make this much in money and revenues, and this is what our expenses are going to be. That's what a projection is. Projection is kind of an if-then, calculation. If we do this, then this is what happens. So, that's the easiest way to say it, but this is where you really get into big financial decisions, where you really need to look at things. So let's go to the next one. So Proforma, I hear Proforma thrown around a lot as just kind of a random normal term for forecast and projection. Proforma is pretty much your financial statements in a vacuum. Okay. If you take your financial statements and you say this one thing is going to happen, okay, and we're only going to do this one simple thing. So most of my projections are probably Proformas, but Proformas of the form. So you're keeping everything the exact same, but you're saying, well, if I hire 5 new people, what's going to happen? Then you would just show the impact of hiring those 5 people. So if you see what I'm saying, but, or if I'm just going to buy this group of customers and here's my 3 assumptions, that's all that's going to happen. Okay. So, going through these and showing everybody what is happening is, each one of these is a different scenario for your company, and every company is different. We're going to have companies that are watching this that are, have 30 subscribers all the way up to 20, 30,000 subscribers. So everybody's in a different stage, but running through these is the right way to look at it, and think about how to do things. Let's go to the next one. So simply put, you're putting together a financial plan or a budget for your business. Okay. Whenever I tell people and talk to people about forecasting and budgeting, you are telling a story. Okay. Most of the time when I talk about projecting and forecasting with people, it's because they want to put something together to go get some debt, to go get some funding, to go do a project, to expand their operations, to upgrade, whatever it is. But what at the end of the day, what a forecast is and what a budget is, it's telling the story of what you are going to do over the next 12 months, 24 months, 3 years, 5 years, whatever it is. Okay. And that's it at the end of the day. Now you can, like I said, you can do it anywhere from budgeting 6 months to, forecasting 10 years, which I think going out anything longer than 3 years is, kind of kind of worthless, but that's how it is. So let's go to the next slide. So why? Why should you create a forecast? If you've never done this before, why would you create one? I really say it aids in your decision making on what you're going to do. Okay. If you're a 50 subscriber WISP and you're thinking about what you want to do you want to grow or you just want to keep where you're at? Or should you spend the money and take a loan out or get a new credit card, go and build on another tower? That helps you in those, in those decisions. But if you're a larger company like Mark trying to figure out, what's the process of building out for CAF2, or, should we go in and get more money? Or I hear that a lot for people. They're asking, should we go and get RDOF money, or should we, look at some loan funds? This is key. You need to find out, is it financially feasible? Is it going to make you money, or are you never going to make money? So the financial feasibility is a huge thing, and that's really taken into account by, Mark says you always operated a negative cash. We need cash coming in. Most of these projections and forecasts and pro formas usually have a borrowing, portion to it. So you have to borrow money to make this big thing happen, or you're checking just to see, for peace of mind, you're checking to see if just your operating cash flow can handle your aspirations, your growth rates, and what you want to do. Because that's what a lot of people do. They just run on operating cash flow, and there's nothing wrong with that. But if you want to go bigger, sometimes you have to do this to prove to someone.
Yeah, Rob, I was just going to jump in there if I can, and I was going to actually mention what you just did, is that, some businesses, they just want to they don't want to take out debt. They want to just build as they grow, and that's fine. There's nothing wrong with that. Other businesses that want to grow aggressively, if you want to grow aggressively in this industry, with the capex needed up front, you're probably going to need to be out there borrowing or loaning money from somewhere. So, there's no right or wrong way. It just depends on what's your strategy and what's your what are you trying to achieve, and that's going to have an indicator of what you're going to need to do.
Yeah, I agree completely. Thanks, Mark. Let's go to the next slide. So it's like we said, all the common whys kind of fits in perfect. So what are the whys that people do this? First one is CapEx budget. You need to really control your spending. I hear a lot of people that, we're hooking up, 150 customers a month. Cash comes in. It's great. We got a lot more cash coming in, but it goes right out the door to, pay for more CPEs or pay for more expansion. They want to make sure that they have enough cash coming in to cover what's going out the door, making sure that everything, so you can control that and not get it out of hand, not get ahead of yourself. Next one is just a cash budget. I hear this more than anybody from owners and general managers, that why do people put so darn much on the credit cards and having to figure out how to pay all those credit cards off all the time, because people will just buy stuff and buy new racks for the warehouse or buy this or buy that. This is one thing that you can do. You can do a cash budget. That's a basic, part of this. And that's just an expense budget by department. Say, whatever you want to do in the warehouse, you have $5,000 to spend. Make sure that you document what you want to buy, and I'm going to hold you to it. Or here's the CapEx improvement fund for the building. We need to redo some stuff on it. So, kind of look at that, but that's how you monitor and control spending. Okay. The next reason is project feasibility. You have a new project you want to do, usually a new tower or a new expansion into a new town. That's where this is key, going in and analyzing it. You can analyze just the revenues, that are going to be, generated from that new tower, or you can look at the new tower and the new employee that you're going to have to get in that town and the new truck that you're going to have to do and all the new supplies and all the new CPEs you're going to have to buy, you can really push this out and get very granular. So any level of that, from just how much revenue am I going to get compared to what it's going to cost me to get on the tower or build the tower, anywhere from that level all the way down to how much it's costing me for every penny that I'm going to have to do. Expansion and growth. These are these last two are the big ones. Large scale expansion of current operations. Looking at that, looking at what you want to do. You want to go and buy your neighboring WISP and then use them to their staff to also go into another town. You need to spend a lot of time on that, figuring out the cash flow needs. Can you do it? Can you make it work? And how much do you need to borrow? There's a lot of different calculations, and Pierce might get into this, but I know that there's different methodologies of calculating how much cash you need to make something work, to also have some cash in the bank and have it be beneficial for you. But just look at it and see how much money you need to do it, and see what operating cash flow you need at the same time. Not just to buy your equipment. That's one thing I like to tell people. Not just to buy the equipment, but also to pay the people, pay the benefits. All the other operations of your company have to expand as you expand. And the last one's business expansion, business opportunity. This is somebody wants to sell their company and you want to buy their company. Easiest way to put it. So let's switch. Let's go to the next slide. Now we're going to look at kind of who uses and benefits from the forecast. It's internally, we benefit a lot from the budget. And when I put forecast in here as budget forecast, all those terms are all kind of interchangeable. But who benefits from this? The owners and the board of directors do, the accountants do, because now the accountants, we're able, and the CFOs and all the accounting department, we know that okay, we should have enough money to cover everything if so-and-so doesn't go and spend it all on something. So you at least have that peace of mind. But the other thing is, this forecast is lenders, investors, and suppliers. They're the big ones, okay? With lenders, you look at, and Pierce will get into this, can the loan be repaid and how much should be lent to the company? And then compliance with covenants, adequacy of collateral, to ensure repayment. If somebody's going to give you money, they want to know that they're going to be repaid and your business is going to be profitable and running very well forward. So you've got to do these things, these projections and forecasts. Investors are going to want to see this. They want to see where you're going. Why would you put money in if you don't know where the company's going? So you really want to know this stuff. And then suppliers, they want to make sure that if they're going to extend credit to you, that you have a good business model, that you're making money, and then you're going to have enough money to repay their short-term vendor debt. So let's flip to the next slide. And then, the last few things that I've got are kind of what analysis do you need? What do you need? Do you need to do a forecast? Do you need to just start with a budget? Are you kind of looking at more of a projection to go 5 years down the road and see what these big things are? If you're looking for, looking to go out for debt, who's it for? Are you looking at suppliers? Are you just doing it internal? If you're doing suppliers, I'd probably just show them a forecast for, 12 to 24 months. Lenders and investors, they want a full-blown 3 to 5 year plan on what you think you're going to do going forward. Internally, you want a budget. You want to know that you're going to have enough cash going forward month to month to operate. Okay. So this is kind of the how do you forecast section. So standard periods. When I put forecasts together in any way, shape, or form, I always have, a minimum of 1 year back, but I at least go 3 years back to show historical trends. You always want to look at what your expenses have been the last 3 years and how your revenue has grown the last 3 years. But my standards always, I go 5 years forward. I really do. You need to have that wish list. You need to have that, well, if we keep going the way that we are, we can get to this point. I think it's really good to be able to, kind of reach for that and have management know that this is where we've been the last 3 years. Here's our growth and here's where we could be. I think it's a motivation tool, but any combination can be used. So what are your thoughts on that, Mark? How do you do it at Whisper?
Sorry, just say that again. Sorry, Rob, I just missed that.
Oh no, how many years back do you look when you do any forecasting or budgeting, and how far forward do you usually go? What's the max that you're doing right now?
Yeah. So what we do in terms of our planning, maybe just the first one is we follow a kind of a model called EOS or traction, and what that requires of us is we certainly we do a kind of a 10-year kind of goal, and that's not a forecast or anything. It's just where do we see ourselves in 10 years time. Then to try to bring that back a little bit, we then have a kind of a 3-year more strategic plan in terms of where do we want to get to in 3 years, and that's a little bit more detailed. We flesh out some of that. What does that look like? In terms of revenue growth, customer growth, subscribers, etc., etc. And then really the meat is in the 1-year plan. But the 1-year plan is kind of the stepping stone that helps us to get to where we want to be in 3 years' time, which ultimately wants to where we want to be in 10 years' time. So that certainly looking forward, that's what we used and implement there. Looking back, like you're saying, is it's very. I like having the last number of years, maybe 3 years, to see. One, it helps to see how you've grown, what has changed over that time period, and sometimes it surprises you when you actually see that, and it helps you then to make those assumptions in terms of how you plan going forward. So I don't know if that's helpful.
Yeah, very much so, Mark. One of the big things that I've been told in different aspects of life is you don't know where you're going unless you know where you've been. And that goes for everything in life, but especially in financials. You can't learn about how your business is going to function going forward until you know how you function to this point. So always make sure that you're keeping track of things properly. And I think that's the next slide. Let's flip the slide. So current financials are always used as your starting point, but the question is are my financials adequate? If you've never budgeted before and you've never really, if you've done, had a tax return done every year, but you haven't had anybody else look at your financials are probably good for what, you'd like to do. If you're just kind of doing budgeting, you know how your business works. So use your own processes, use your own financials to move forward because you know the business better than anybody. So are they adequate, internally prepared versus externally reviewed? Internally prepared are usually adequate for when you're doing budgeting and forecasting. And I do that a lot. I don't, for my companies now that I'm not the auditor, that I'm their, internal CFO, I'm preparing things not on that auditing standard, but on their internal financials and how they work through things and how they see it. So I'm seeing that whole different side of things. But there's nothing wrong. Everybody does it separate. Everybody does it different, and everybody wants to see it different. But at the end of the day, if you're looking at something, like you want to go out for debt, you need to really look at how it should be presented. The best way to do it is to have somebody help you with it. If you're going to a bank, it's going to be easier, or looking for investors, they're going to want to see stuff on kind of the GAAP accounting method, kind of a CPA firm, or, somebody, your local CPA, local tax person, anyone like that. It's have somebody help you with your processes. So, and the last thing is, kind of assumptions. This is what Mark was talking about. He started to get into that. How do you assume what you're going to do? This is the why. Apply your why to the future years. Let's go to the next slide. This one's my last one. So, what are you going to do and what you expect to happen? That's your assumptions. This is how you tell the story. Okay. The one thing I will tell you is when you put a forecast together, a budget together, have a balance sheet and income statement, have whatever you're doing, but also have just a Word document that tells and details all of your assumptions. Okay. And writes them out. When I do these, I still do a nice, a pretty report that like I used to do, but I always, type everything out, lay it all out on exactly what I'm going to do. But the basic assumptions in the telecom industry, this is what I've seen over the years, and this is exactly what Mark went to, what Mark was alluding to, is these are the standard, cycles for the industry. We know that the industry is very based on, we're very infrastructure-based, companies, and we have a lot of payroll, a lot of labor to keep those infrastructure going. So we got CapEx, borrowing, cash infusion. where are you going to get the money to do it? Changes in revenue streams, changes in expenses. You're going to have to do more on your internet circuits, more benefits, more payroll, change your benefits. You have to calculate your depreciation, property taxes, interest expense. We can go on and on and on. So there's a lot of different things to look at in here, but like Mark said, we're always open to, any help that we can give anybody on how to do these things. But at the end of the day, you can start at any level and you can do any level of, predictive analysis is what I kind of came up with the word for it when I wrote this part of my presentation. So, let us know if we can help, even to talk through it and figure out how to, get to a spot or how to start doing it. So I appreciate your time, and I will pass it over to Pierce.
Great. Thanks, Rob. Pierce, you're up.
Well, thank you, Martha, and Rob and Mark. Thank you very much for providing that insight. I think I'm not going to tell anyone on here what they may already know. However, would love to share a little bit from the banking side, just how we approach budgeting and forecasting, especially for this industry. And for anyone who may not know, Live Oak Bank, we are an FDIC insured bank that was started in 2008, and our home base is Wilmington, North Carolina. We're a nationwide lender, but that's really where we stop looking like a traditional bank, because we only lend to small businesses across the country, and we dedicate teams solely and hyper-focused on specific industries. So myself and my colleague, who many of you may know, John Scrivener, are heading up the broadband lending division at Live Oak Bank. And we have underwriters, lenders, credit officers, and closers all dedicated to this industry. So really understanding how the industry works and how these budget and forecasts would affect broadband providers specifically. So Martha, if you wouldn't mind, we can start in the presentation. So as Mark and Rob mentioned, there are really three components of this process: the budgeting process, the forecasting process, and the strategic planning process. As Rob mentioned, a lot of the why, that's going to be your forecasting and strategic planning. Where do you want to be? Do you want to try and build a company that is, to Mark's benefit and his experience? Do you want to focus on that growth and go out there and strive for that level of success? Do you want to maintain your success that you have currently, which may just be a small handful of customers? It's really up to you. It's really how you decide you want to run your company. The budgeting and forecasting process just play a major role in figuring out and getting to those objectives and goals. Next slide. So today, I know that we've kind of gotten a little bit in the weeds and also tackled high-level questions, but I'd love as well to go over just the benefits of the budgeting and forecasting profits from the point of view of a lender, and maybe how it may relate to operators in the space. So talking about preparing for business contingencies, such as potential speed bumps along the way when you're growing or operating your company. How prepared are you for those items, and do you have the cushion built in to absorb those as they come? Secondly, attracting future investment. That would be where a lender or an equity partner would come in and help fund that growth. Because as we all know, the CapEx and OpEx in this industry is expensive. And so how do you fund that? Do you fund that from cash flow, or can you use other vehicles such as debt or equity to help fund that? Thirdly, tracking performance against targets. Typically, lenders will look at how you've performed historically and trying to measure up against maybe competitors or folks in the industry, or maybe metrics in the industry that are available, and how future forecasts and future growth targets are going to be able to maintain that. So those targets and that performance, both historically and then how you're forecasting out in the future, that's going to help a lender understand your goals and how to hopefully partner with you in helping you achieve them. Another aspect and benefit would be just predicting cash flow. Both Mark and Rob mentioned this in their presentations as well and in their discussions. cash flow is king. It is an area of business in whatever industry you're in that is extremely important in understanding the ebbs and flows, whether you're a seasonal business or one that, like this industry, experiences recurring cash flow through the subscriber revenue on a monthly basis. So how can you extend out that recurring nature and not necessarily be reliant on one-time inflows of cash? And lastly, we'll talk about the collaboration aspect. Collaborating with the lender is one thing, collaborating with investors, but also employees and folks within the company, getting you all in I believe Mark mentioned it, the centralized approach, and making sure that, from that standpoint, that everyone would be on the same page, whether it's a lender like a Live Oak Bank, or whether it's equity partners, or just folks within your own company. Next slide, please. So the contingencies. What happens when equipment installation or construction comes in, off budget? How do you prepare for the unknowns? And a great example of this right now is the COVID pandemic. And how does this affect, industries or your supply chain? These are all, what we would deem from the banking perspective as contingencies. However, there's really no need to go out and change your budget right away, but it's how have we built the budget to accommodate for this? Have there been contingencies or areas in which you can pull from to be able to prepare for bumps along the way? In this industry, it is fantastic to know that from a demand standpoint, things are going very well right now. But some other industries may not be, and they may have an effect. So understanding what the risks are in your specific industry is something that lenders will look for, but also as an owner operator, it's something to understand as well, because no one has a crystal ball. But at the same time, if we can mitigate the risks that are present, whether it's from a lender's eyes or an operator's, it's certainly helpful to know and can ease out and elucidate any hardship or struggles that you've previously maybe had with a partner, whether it's a debt or equity partner. Next slide. The key slide here, I think from our standpoint, is just attracting future investment if you are looking for that, albeit debt or equity. Our bank is very much so focused on that data for decision making, whether it's forecasts, whether it's historical financials or Proformas. Those are all statements, the balance sheet, income statement, and cash flow statement. Those are all documents that are always referenced in making decisions at lending institutions, because one, it demonstrates thoughtful growth and thoughtful management, but it also, focuses on that one aspect of strategic planning. The business has thought about where they want to go. They've thought about how to budget effectively year over year as the company grows or as the company takes on more subscribers. And then lastly, from a confidence standpoint, it increases the confidence of any financing partner, debt or equity. Folks that come to a company, they want to know exactly what the risks may be, but also how to get them to that next step, because at the end of the day, cash flow is what repays, whether it's an investor or whether it's a debt partner. That's what repays that. And from our standpoint, understanding the ins and outs and the challenges will get us at a point where we are able to partner with companies to be able to take advantage of opportunities in the industry. And the metaphor that I most liken it to is if you take your car in, oftentimes, the mechanic's never going to be able to know exactly what's wrong until they open up the hood and really see what's under that. So having detailed financial statements and budgeting and forecasting is a great way to let other folks who you want to partner with really see under the hood. Next slide, please. The other aspect, performance tracking, this goes hand in hand with, I think Rob brought it up and asked for Mark's input, with how have you done historically? Budgeting, it's a goal setting metric. We allow for, and hope to hit budget every single year. But how have you done historically? And then trying to forecast that out really that sets in place the strategic plan that you and your team have set for yourselves. And, my second bullet of, forecasting may fluctuate, that's something that is a fact. It's something that changes every day. But it's one item where if we can see under that hood, like I mentioned earlier, and really understand from a lending standpoint what is going on day to day, that helps any partner within your business, whether it's suppliers or vendor relations, whether it's investors, whether it's your employees, or whether it's a bank partner. It helps us understand, again, the challenges, but also the opportunities that a company may face over the next 6, 12, or 24 months. And then lastly, going along with that theme, the performance tracking also increases the transparency that either debt or equity providers are looking for. They really want to know how best to use capital, whether it's debt or equity. And if we're able to partner with businesses who are adamant and disciplined about keeping financial reporting, whether it's a budget or forecast, whether it's projections, and how those moving targets are going to be achieved, it's something that makes for a great relationship when thinking about how do I get readily available capital, whether it's debt or equity, whether it's for expansion purposes, whether it's you're thinking about moving into a new piece of real estate, or whether it's looking at selling what you've built. So always keep in mind that performance tracking is a key component as well when thinking about the budgeting and forecasting process. Next slide, please. Next slide, please.
This one. Is it not moving?
I'm not seeing movement on my screen.
So now I'm on predict cash flows.
Okay.
You're not, okay. You're not
Okay.
seeing that?
Yeah, I can go off that then.
Okay.
From predictability of cash flow, we mentioned it earlier, but it is the lifeblood of any business. When you are experiencing increased monthly cash flows and you're growing a business, that's something that positions a company. One, it positions it for growth, for natural and organic growth, and being able to finance your own expansion. But also, when you do want to leverage debt or equity partners, that is something where the increased ability to support those obligations attract, to the earlier point of that slide, attract future investment. And so really from a budgeting and forecasting standpoint, you're able to figure out, what does my company look like in 6 months? What does it look like in 12 months? If I were to target an adjacent territory and try and build out fiber to a specific municipality, how would that affect the livelihood that I have? Because I depend on this business and my employees depend on this business for their livelihoods. So how does that working document, how does that change your ability to target what may be prudent at this time? And it also helps from the lending perspective really understand how to best structure a loan facility for a business. Do we need to set aside funds for 6 or 12 months to be able to work through a fiber expansion project? Do we need time to build out tower sites and equipment installs and finance truck rolls? So understanding from a budgeting and forecasting perspective really helps all involved, whether it's within the company or outside the company, understand the true needs of the business. And then lastly, to that point, it allows lenders to provide that capital efficiently. If the debt is provided all at once and we expect to make principal repayment immediately, that doesn't work for those who need 12 months to build out a specific project, to bore the fiber, hang the fiber on telephone poles. So it's an area where until we are able to see under that hood and understanding the project at hand. And that's something that, is necessary for us to adequately and efficiently provide the capital that folks and operators need. Next slide. Okay, showing up now. And then the last item I had was just promotes collaboration. Now I input the collaborative efficiencies from inside the company. Obviously, from externally, the collaboration aspect between a lender or an equity partner, that's something where I've mentioned in the previous slides of really allowing for more clear, transparent communication, and the budgeting and forecasting tools allow for that process. But outside of that as well, when looking at the collaboration that's within the company, you all will see benefits as well. More frequent communication in making sure that everyone is in line with that budget or with these strategic goals that you may have set. And collaboration as well within the departments may provide some efficiencies that otherwise would not have been recognized. And so if I found in my limited experience with the broadband industry, that when working with folks, it's something where, each department has their own specialty, and allowing for those specialties to really collaborate on an intra-company level, unlock some efficiencies that may not have otherwise been realized. And that gets into the whole top-down and bottom-up approach of budgeting. And so really understanding, that efficiencies could be at play, that may also tie in, again, with a lender. If you're looking at an acquisition opportunity, understanding the efficiencies that could be had as a result of acquiring a local competitor and building in that network with your own. That's something that a lender is more than open to listening to, because they want to understand how the business is going to look again in 12 months after they've been able to consolidate staff or open up a second location or take advantage of the existing infrastructure or equipment that's out there currently. So all in all, the collaboration is, focused on, from a lending perspective, it's focused on how the borrower and lender can work together. But at the end of the day as well, it's a benefit to promote the collaboration within the company. And so those were the bullet points that really I wanted to focus on from a high level, because there is, specific and identifiable benefits in budgeting and forecasting. However, if more items come through and more questions around specific to lending and how banks may look at this, I'm more than happy to talk about that after the presentation, but wanted to at least highlight the primary benefits of this process. So I appreciate the time that you've allowed to let me speak with you all about that.
Great, thanks, Pierce. So since we don't have anyone to ask questions of us right now, I think hopefully people will respond, and that we'll have, they'll have opportunity to get emails of the presenters. But what I wanted to just ask, because a couple of things that came up over the time was with, I think mostly with Rob and Mark, but adjusting your budget. And I think probably people don't do that as often as they should, don't know when they should do it. And so I just kind of wanted to ask, so that we could get more clarity around it, is, should you revisit it at certain times only when you're having trouble? Should you revisit it every quarter, when you're preparing for the next quarter? So I just wanted to kind of get your thoughts on that for people, because I think that's helpful to people, that they can adjust their budget, and when do they do it? Because I think you don't want to do it just when you're having trouble, but I'll let you guys talk about that.
I can jump in real quick. My thoughts are, you analyze the budget monthly, but then every quarter you look back and say, should we readjust this, the quarter back, and then look at, our assumptions still correct going forward. But I think that's, you look at it, you explain the differences. Like Mark said, 5% is a good thing, but I think that, analyze it and recast. I hear that a lot as a word to do it. Recast every quarter. Mark, what do you think?
Yeah, I was going to say For me, it's has one of your major assumptions changed? Perhaps maybe that's kind of the trigger. You know, has there been an event or a circumstance that's happened in your business which would trigger you to say, well, you know, the assumptions under which I was operating no longer hold true for me. And then it kind of almost is, you know, it's like a broken pencil, pointless, kind of trying to go down the same road on the budget that you had set up, because things have changed. So yes, you don't want to go about changing your budgets every single month. You know, that doesn't make sense. I'd say at the shortest, maybe on a quarterly, as Rob says, a quarterly basis, if your circumstances have changed. Otherwise, you know, sometimes you just have to hang in there and see your budget out, and then reevaluate at the end of the year. But certainly, as I said, if something major changes and it's not working, then do it by all means.
Great, thanks. And I think that is going to lead us well into our next presentation, where you'll see all of us again with monthly reporting, or some of us at least with monthly reporting, because I think from my business perspective, because I have a WISP as well, that when we get to the end of the quarter and when we're looking, or the end of the month, and we're looking at things, our monthly reports, that's when we're really, apt to say, hey, this isn't working, and, our assumptions have changed, and now we need to revisit the budget. So with that, I think thanks to everyone for your presentations, and I think we're good. Thank you.
You're welcome. Thank you, everyone.
Thank you.